It's definitely, like you said, it's been a pleasure working with you, hosting different events. Nice to see you, Maxine. I know we have Neil and Marianne. I'd like to kick it off first. Neil, if you can unmute him, what type of business are you in?
I'm in television. I make motion pictures, but mostly in reality TV. I do a lot of post-production work here in Los Angeles.
Nice. Nice, very good. Well, glad to have you here. And Marianne, I know Marianne, but I'll have you introduce yourself for the other people on the conference.
Hi, everyone. Glad to be here today. So I own several different businesses. One of them is an automotive repair shop, and the next one I'm coaching as well, businesses that are in that space.
Very good. Welcome, Marianne.
Thank you.
All right. All right, very good. So I'm very happy to be sharing this topic. Obviously, I spent most of my career in financial services, mostly in life insurance and retirement planning. I picked up a degree in accounting and financial management, along the way. And so it gives me a broad range of topics that I can speak on. I think this one is definitely important for small business owners. I have a fair amount of bookkeeping clients and people who come through for tax return preparation. And I think that the general dynamic is that as a small business owner, accounting, bookkeeping is not the most interesting thing that you want to do for yourself. But as soon as tax return comes, everybody's just flocking. Whenever the deadline is coming in, just flocking and wanting to get these tax returns, prepared. And I think that that's part of the missed opportunity. Part of the missed opportunity is we get very little time to do some high-level planning with small business owners. Finances is not a topic that we, discuss on a monthly basis. So I'm happy to put this together to give everybody kind of a larger scope of what they should be doing in terms of planning, or at least for today, for everybody to understand, the options that are there. So purpose of us being together, number one, is I never let go of my main mission, which is to help people reach financial freedom, financial independence. It means different things. Some people say retirement. I don't know if it means different things to you, but to me, retirement and financial independence or financial freedom are two different things. So I want to touch upon that topic for a couple of minutes. Then we're going to talk about the actual taxes, how to reduce your tax expenses as a small business owner. It is much easier to reduce your expenses as a small business owner. There's a lot of different, options and things that you have to think about. So I want to touch upon that part. And lastly, we're going to talk about diversification, how to diversify your income, in retirement, your investments and your income, in retirement in light of taxes and everything that's going on. So that's the purpose of us getting together. I welcome questions throughout the entire presentation, throughout the entire conversation. You can just put them on the chat line, and if somebody sees it, just alert me very quickly so I can make sure that we can answer the questions and dig deep into a topic, as opposed to just going through, a lot of content, a lot of theory, a lot of examples. I want to make sure that it's relevant to people in the room. So I'll be sharing a couple of things. Number one, I want to share a quick formula to calculate your retirement savings needs. Everybody has an idea of how much money they would like to have, but I'll give you a very quick formula as to how you should be calculating it. As discussed, we'll talk about the 3 buckets of taxation, the 3 different types of ways that you can either pay taxes now, defer paying taxes, or never pay taxes, whether it's on your income or your investments. We're going to talk about tax planning. It's very important to pay attention to that, because I think that's the missed opportunity for small business owners. We're going to talk about the different types of savings. And finally, we're going to talk about, I think the most important part is how to get some tax-free income, So, at the end of the presentation, anybody who's here can get access to a resource that I want to share, which is a list of different tax deductions that small business owners should be going through to make sure that they're maximizing their particular position. So my first question, and I'll ask Maureen, looks like there's somebody on the chat line right here. Okay, no, all right. So I'll ask Maureen and then Maxine. When I say the word retirement versus financial independence, to you, does it mean the same thing, or do you feel like there's a difference?
To me, there's definitely a difference. You know, and since I'm not in my 20s anymore, it's definitely something that weighs on my mind. Financial independence to me means not having to worry about a regular paycheck or a regular income, whereas, what was the term you used to compare it to?
Retirement.
Retirement just means I'm not going to an office every day or, you know, something like that and getting a regular paycheck, but I'm dependent upon my savings or annuities, you know, and Social Security or Medicare or whatever those things are. That to me is what retirement means, that I'm completely dependent on those sources of income. That's why I play the lottery every day.
What about you, Maxine? When I say retirement versus financial independence, does it mean the same thing to you, or is there a nuance?
I don't think they mean the same thing. I do have to agree. I think Maureen said it very well as well, of the difference between the two. And I think retirement, I think my parents. And I think of the joke that my dad always tells me, keep working so I can keep collecting Social Security. So that's what that definitely means to me. And financial independence, I feel like exactly how Maureen kind of put it, you're not dependent on a paycheck, but your finances are stable enough, I guess. She knows more than I do.
That's good. We'll take one more. Neil.
Sure.
Neil, what is the nuance in your mind between retirement and financial independence?
Well, to me, financial independence, I mean, because retirement is not something, though I do have retirement savings and I continuously put stock money away, I don't see myself retiring anytime soon. I see myself working well into my late 60s, if not 70s, if I can. And financial independence is not relying on one source of income, but on a variety of sources of income that are generating, you're not working for the money's working for you. So it can tie into retirement, but like retirement is something I'm planning for, to have that additional income coming in, where financial independence will allow me to maximize my later years, or even now in my 40s, where I can do what I want and be who I want and not really feel the burden of the costs that is associated with that.
That's very good. That's very good. It goes along the lines of what I think. I think retirement to me is a reduction of activity in your main career, main business. You're really just not doing the work anymore. Financial independence in what I'm sharing today is about not having to work, whether you decide to work or not. I always remember I used to work at Pacific Life, for example, and there was this, I would say about 85 or 87-year-old attorney who would just get on the bus in the morning at 8 o'clock on Wednesdays to go to court. So, it just, to me, retirement is stop doing what you are doing to earn a living. Financial independence is not having to work at all in order to sustain your standard of living. So I wanted to share that very quick formula before we head into the tax portion of it. I'm sharing this thing here. There's a very quick way for you to calculate it, depending on if you are an aggressive investor or a conservative investor. So what I want you to remember is, take your annual budget, all your expenses, vacations, everything that you like doing, take your annual budget, multiply it by 20, and then do the same thing. Take your annual budget, multiply it by 40. So that's going to give you two numbers. And I have some examples over here. For example, for somebody who has an annual budget of $100,000, if they can set themselves a goal, a financial independence goal of accumulating $2 million, for example, and they're an aggressive investor where they can get close to like 5% of their money, they could basically live on the interest of their money for the rest of their lives. Does that make sense?
Mm-hmm.
All right, very good. So 20 times your annual budget is a financial independence goal, quote unquote. So that's for aggressive investors. If you want to be more conservative and more realistic, you want to go more around 40 times your annual budget. So for example, for somebody who wants to live on $100,000 a year, if you have $4 million in the bank. And even if you go to the lowest interest-bearing account, very conservative, 2.5% is very conservative, very safe right now. You can live on the interest of that money, earn that $100,000, and you're financially independent. You technically don't have to work or do anything in order to sustain your standard of living. Now, that number is going to get increased because of inflation. So inflation is the cost of living goes up every single year. So although you're living on the interest of your money, you want to make sure that you might create yourself a buffer, because things that we can do for $100,000 now, it's not going to be the same thing 15, 20 years from now. It's going to be a lot more. So that's number one. So financial independence, retirement, that's why we work. That's why we start our business. Of course, there's some deeper purposes for a lot of people, but at the end of the day, you bring in the money, you want to save part of it so that one day you don't have to keep on doing. You don't want to be sitting on a treadmill, working, doing the same thing for money all your life. This quick slide here was about inflation. I always move this thing to the side here. So this is a chart in the past 100 years. This is a chart of inflation. If you look at this here, can you see my cursor when I move this around?
Yeah.
Yes.
All right, very good. So this is a chart of inflation. That means how much does the cost of goods go up every single year? If you look at the more recent years, we're right around, 2.5%. I don't know what used to happen during those years over here. It used to be crazy, but it's kind of stabilized where nowadays, in the past 20 years, inflation has been somewhere between 2.5% to 5%. So you want to make sure that if you're investing money, if you're saving money, if you want to keep up with the cost of living, you want to make sure that you're earning at least that 2.5 to 5% just to keep up, with the cost of things. So that was the concept of financial independence. So in order to reach that faster, more efficiently, you have to be watching three things for the purpose of what we're doing today. Number one, how are you taxed on your current income? Number two, how are you taxed on the growth of your savings? And number three, how will you be taxed on your retirement income? So those are the three things. If you're focusing on a particular financial retirement or financial independence goal, you want to pay attention to these three things: your current income, the growth of your savings, and also how will you be taxed when you decide to start to take that money out of it. For now, I'm leaving Social Security out of the picture. From my calculations, most of the plans that I've done, Social Security usually covers maybe 20% of what you'll need. So if you have Social Security, it's kind of like an extra. It doesn't really cover your entire, standard of living. Social Security, for those who contribute to it and use it, it's only covering about 20% of what you're going to need. So I'm leaving it out of the equation for now, if it's okay. So income taxes. So let me ask this second question. We'll start with Marianne. Marianne, do you think taxes are going to go up or down in the next 20 to 30 years?
Up.
Up. You say up, all right. What about you, Neil?
Up.
Up. Maxine?
I agree, up.
Up. Maureen?
Maureen's going to be the outlier, and Maureen's going to go with down because they're already so goddamn high. We might as well move to another country.
Move to another country. That's so funny. I can't see your faces, but this is the second chart here. I charted the actual income tax rates for the highest earners in the U.S. over the past 100 years. So imagine, you see how high this used to be? The trend has been that taxes has been going down. I don't know if we're going to get back in the trend where taxes are going to go, higher up. Obviously, in the past couple of years, the income tax rate for higher earners has gone down. So you want to keep an eye on that because, depending on your philosophy, whether taxes are going to go up or down, you're going to make decisions differently regarding what we're sharing today. So here's the main thing. There are three buckets. I call it the three-bucket concept. There's three different ways that you can, handle, or there's three different ways that your income, the savings, the growth on your savings and your retirement income can get taxed. It can either get taxed now, or you have to pay taxes every year. It can get deferred, which is why I call it 1099 later, or it could be tax-free. Now, from my experience, most people are dealing in this bucket over here. If you're working for a corporation, if you're working for yourself, most of the time, we just pay taxes right now. You pay the taxes every time you go to the supermarket. You pay taxes every time you get a paycheck. And every year, at the very least, if you own a business, you got to pay taxes on it. Same thing if you own an investment account or a savings account that's called non-qualified, you have to pay taxes every year. So the 1099 is the form that the bank or the financial institution sends to you, and it basically says, here's how much you earned, and you should be paying the government your taxes right away. So that's the first bucket, tax now. The second bucket is tax later. We're going to get into these strategies and what can you do with your income, what can you do with your savings so that you don't get taxed right away on it. You're kind of giving it an opportunity to grow instead of always taking out the taxes to pay the government. And the third one is we're going to take a look at a couple of options for you to never have to pay taxes on the gains and the investments that you make. So we covered this here. So the income tax brackets for 2020, for most people, they're making close to $100,000. The income tax bracket, it goes from 24 to 37%. That's the federal. If you add the state taxes, which are around 16%, some people can get taxed close to 43% of their income. That's a lot of money. You know, that's like one day out of the week or a third of the week. That's just basically you're working for somebody else. You're working to pay taxes. That's why it's important to pay attention to this and be really smart about some of the things that we're sharing today so that you come out ahead. That's why we're together. Is if you're paying attention and you're implementing these strategies on a daily basis, on an annual basis, you might see a small difference. But if you're really trying to reach that financial independence goal and you pay diligently attention and applying these things, then you're definitely going to come out ahead. So for regular people, it works like this. I would say regular people, I say people who are employed, or your personal tax return works like this. You know, you get your income, whether you get it from a business or whether you get it from an employer, and then whatever you save for retirement in those types of accounts, you don't get taxed on. And then we have what's called some deductions, a standard deduction. On a regular tax return, we all get what's called a standard deduction. For single people, it's around $12,000. For married people, it's about $24,000. That standard deduction is what you will not be paying taxes on. So again, you get your paycheck, you save money for retirement, you get some type of standard deduction, and that becomes your taxable income. Your taxable income is what you get taxed on. Some people start to itemize their deductions. So let's say there's a standard deduction here of $12,000. If you can come up with more than $12,000 worth of deductions, then it's worth the time. It's worth the time for you to pay an accountant to go through all that. It's worth the time for you to itemize all these things. If not, you just take that standard deduction. It's going to be a huge reduction, on what you made, and you'll pay taxes on whatever is left over. So that whole idea of itemizing versus standard deduction, is that something that you've come across before, Marianne?
Yes.
All right, very good. Who has never come across that concept of itemizing versus the standard deduction? All right, pretty much everybody. We're going to assume everybody has. So as a business owner, and that's the meat of what we're discussing today, as an individual, you have a standard deduction that the government basically says you're not going to pay money on that $12,000, or you're not going to pay taxes on that $12,000, on that $24,000. As a business owner, when you're filing taxes for your business, there's not such a thing as a standard deduction. So everything that you spend that's for business purposes is technically eligible to be a deduction. So tip number one that I would give to any small business owner is to have a very solid QuickBooks account where you monitor all your income, all your expenses. So you have to be honest with yourself. I gave this presentation a couple of different times. Sometimes I just post it on social media. Step number one as a business owner is you want to make sure that all your business income gets deposited in a business account, regardless of whether you get it from Zelle, or you get it from Cash App, or you get some PayPal. You want to make sure that all that money gets deposited in your business account. And you want to make sure that every time you spend something for business purposes, it all goes through your QuickBooks account. That gives us the opportunity to take a look and do some tax planning. So document all your income and your expenses. So there's a couple of, there's a list, which is the one that I wanted to share after this webinar, is a list of about 75 different tax deductions that you could claim. And the process of tax planning is the process of you just taking a time to go through that list and seeing which ones could apply to you. So most people, they go throughout the whole year. When tax return comes, they rush. They get all the paperwork, all the receipts, dump it, at the accountant's office or at the H&R Block. They sit down here, and they try to come up with as many deductions as possible. Unfortunately, some people lie about numbers and do different things. The right way to do it, if you want to play the tax game right, is to do the opposite. You will get the sheet that I'm sharing. You'll go through all the deductions that are possible, and then you could put a check mark and say, you know what, I could possibly get that deduction, or I could work towards getting that deduction. So you'll have a much more controlled process. So after going through all these deductions, you want to make sure that throughout the year you document all your expenses related to that deduction, and that now makes it a legitimate, tax deduction. So you want to document all your income and your expenses. Some of the most common deductions that some people miss out, some people have never heard about. Number one is the home office deduction, especially now in the light of COVID. You can get a home office deduction. So if you wake up and do some work from home, or if you actually have an office at home that's set aside, you can get part of your rent, your utilities, your homeowner's insurance, interest, property taxes. You can get part of that. That money that you spend, you can use that as a deduction against your business income. So the way it works, the home office deduction, it all depends on how big your house is and how big your office is. So I have the formula right here. For example, you take the square footage of your office. So for example, if you have a 1,500 square foot home and you have, let's say 140 is the standard room, 150 square foot office, and that's basically 10% of your home is used for business purposes. So 10% of these expenses can be used as a deduction on your tax return. Does that make sense? Does everybody, anybody have some questions about this one here? Or is it home office deduction simple enough? I don't see the head nodding because I don't see all the things, but.
No, so the rent portion, I already utilized this deduction. I'm just trying to get, because my accountant normally handles, I'm just trying to get an understanding of how he gets the number that he's getting for my rent that I'm renting back. So you're saying, so I do have a 1,500 square foot home and I have a dedicated guest home, which is 300 square feet or 284 square feet. So how do I get at the final number that I should be deducting every year?
Well, typically typically on a perfect situation, you want to have an office that's separated, that's typically just for business. Okay. The nuance is up to you and your accountant.
Okay.
So the accountant will give you the best practices as to what to do with that space. But in a perfect situation, you want to have a space that's just strictly for business. It's just enough. So that way it's clear that 10% of your home is being used for business purposes.
The entire cost. Got it.
Yeah. So then 10% of your rent can be used as a deduction against your business income. Same for utilities, homeowners insurance. Here you have mortgage interest if you actually if you actually own the home, property taxes, all those things, a portion of it can be deducted against your business income. That's the home office deduction. The second one that I see a lot of small business owners missing out on is they have all the income, they have all the expenses. Eventually we get them to document everything and everything goes through QuickBooks. But what's not a natural thing is, what about all the assets, all the equipment that you buy? So if you're buying computers, if you're buying equipment, if you have a construction company, especially you, Neil, you have a video production company. So you're buying cameras?
And post equipment, yeah.
Yeah, so all that equipment.
Sorry.
No, go ahead.
I said lots of computers.
Right, lots of computers. So do you document when you buy a computer? Do you document when you purchased it, the sale price, the date and everything?
Yes.
All right, very good. And does that get transferred into your QuickBooks where you can see a list of all the equipment that you have?
Yes.
All right. What about you, Marianne? I know you have one of your businesses is transmission repair, correct?
Yes, that's correct.
All right. So do you keep a record of the tools that you buy and different pieces of equipment like that?
Yes, we do.
All right. Very good. So obviously, if you have a CPA, you have an accountant, these things are going well. What some people don't know is there's something called Section 179. So Section 179, when you actually buy this piece of equipment throughout the year, actually 100% of it can be deducted against your business income up to $1 million. So again, you know, every time you buy a piece of equipment, it used to be that you can only depreciate it and deduct a certain portion of it against your income. There's now a new rule called Section 179. You want to see how much you can utilize that, because everything that you buy in terms of equipment, you know, can actually be deducted against your business income up to $1 million. So that can be a very good one to take advantage of. I'll share another one, Section 199. Have you ever heard of Section 199, Neil?
No.
Okay, what about you, Marianne?
No.
All right, Section 199, I would say it's been there for about 3 or 4 years, but literally if you have an LLC, if you have a business, you can qualify to deduct about 20% of your business income. If you operate as a sole proprietor, a partnership, a corporation, or a trust, that's an automatic additional deduction of about 20%. So what you want to do is take a look at your tax returns, or ask your accountant, well, I wouldn't say ask your bookkeeper, but ask your tax preparer or ask your accountant if you qualify for Section 189, and, you know, how much have you been able to deduct in the past couple of years, because that's literally another 20%, 20% of income that you don't have to pay taxes on. All you have to do is qualify for it.
Oh, wow.
Yeah, so you want to take a look into that. I would say that most software, if you're using like TaxAct, you know, softwares that people use and prepare their taxes on their own, it's not necessarily geared to go and you look for that deduction and apply it. But if you're dealing with a CPA, you're dealing with an accountant, they should be able to use software that's sophisticated enough to have that deduction. So that's another 20% right then and there that you can unlock and not have to pay taxes on. So I shared about 3. Like I said, at the end of the presentation, you'll be able to download that sheet. On that sheet is probably about 75 of them. So there might be some that you're currently using. There's some that you can actually gear yourself towards using in the future. And so doing this on a consistent basis is what I call tax planning. And that's what's going to allow you to really crush down the amount that you pay on taxes legally. There's a third one before we go on to the next topic, is legal entity optimization. So for example, Neil, how is your business set up? Is it an LLC?
It's an LLC, and we're taxed as an S Corp. And I'm also doing business under another name here in California.
All right, very good. What about you, Marianne?
Yeah, same thing, LLC, but we're taxed as an S Corp.
All right, very good. So I can skip this one. The next step is to go towards a corporation. Obviously, you know, the S Corp is sufficient enough right now. You know, in your current situation, you only pay taxes on the salary that you pay yourself. Corporation has this concept of like double taxation. There's some advantages and disadvantages to it. But for some people, the corporate tax rate is a lot lower. So for example, if we go to this slide over here, the corporate tax rate has been around 21% since 2016. And so if your tax bracket, your personal tax bracket is high up there, then, you know, opening up a corporation is a good idea, because the overall, you know, tax rate on the money that you earn can be lower than what you would pay on the personal side. Does that make sense?
Mm-hmm.
Yes.
All right, so that's corporation. So, all right, so now that we've discussed all your money coming in, that's the number one thing that you should be watching, is the money that's currently coming in, trying to minimize the amount of taxes that you're paying on. The second thing is to think about the savings that you're having. You know, where are you saving your money? And how is that interest, or how is that capital gains, or how is that being taxed right now? So there's 3 type of accounts. Of course, there's the tax-free accounts, and I'm leaving for last. And we're coming close to that. There's the taxable accounts are pretty easy. Taxable accounts is your checking account, your savings account. You know, you receive the money. If you earn an interest or anything like that, you'll get taxed on it at the end of the year. The tax-deferred accounts can be things like the IRAs, the 401ks. Actually, regular annuities are tax-deferred, so you don't pay taxes until you actually take the money out and use it. And the tax-free account, there's a couple of options that I wanted to get to that and discuss that with you today. So, you know, the main, you know, 2 breakdowns in the tax-deferred accounts is the traditional IRA and the Roth IRA. Again, the traditional IRA, you get a tax deduction for everything that you contribute right now. So that's why it says it's a tax break right now. So as a business owner, if you save money inside of a SEP IRA, inside of an IRA, if you have a simple K, I'll go through the different types of accounts. Every time you contribute money to these retirement accounts, you're reducing your tax bill. So as much as you can, contribute to your retirement accounts, because not only it'll help you reach that financial independence goal, but it'll also reduce your tax bill. Tax break later is the Roth IRA. So if you are receiving your money and you actually think that taxes are now I got off track for a second here, but if you believe that taxes are going to be higher in the future and you want to pay taxes on it now, you can open what's called a Roth IRA. There's also Roth 401ks. So those things do happen, or you can also do a conversion from a traditional IRA to a Roth IRA. And that's going to allow you right now to pay the taxes, but not have to pay any taxes on that money when it comes out of the account. So you make that differentiation. So, Marianne, do you have any Roth accounts set up right now?
Yeah, we have qualified. We have both.
You have both, okay.
Yeah.
What about you, Neil?
Yeah, I have several different accounts, all retirement, but Roth, traditional, and I have a SEP IRA as well as one that qualifies a profit sharing plan.
All right, very good. Very good. So in terms of the different ways or the different places that you can actually share, you can actually save money, I've kind of created a matrix over here. So we've discussed these, the Roth IRA, we've discussed it. The IRA, we've discussed it. And when I say IRA, it does mean individual retirement plan. So all the SEPs are included in there. If you have a 401k, it's considered a qualified IRA. So there are some funding limits on all of these. The Roth IRA, there's also some funding, funding limits. You have regular mutual funds. If you open up a brokerage account, it's at Fidelity, Charles Schwab, regardless of what your financial institution or who your financial advisor works for, are all these individually owned mutual funds, or another way to save money towards retirement. But, you don't necessarily get the deduction now. As a matter of fact, if you sell stocks or you sell bonds throughout the year, you might end up having to pay taxes throughout. The options that are actually tax-free is the municipal bonds and life insurance. Those are the two right now that we can say you can save money in. You can accumulate a large amount of capital gains, or you can accumulate a large amount of profit, a large amount of interest without ever having to pay taxes on it. So municipal bonds, you have to do a little bit of research, or you just ask your financial advisors. Most municipal bonds give you, tax-free income. And you have to double check that these particular municipal bonds are tax-free for the state. But on the federal level, most of them provide tax-free income. The last one is life insurance. So life insurance, cash value life insurance. How many, I would say here, who has cash value life insurance? Neil, do you have any permanent life insurance in place?
Permanent, yes. Not for cash value, no.
Okay, you have permanent, yes, for cash value, no. Okay, very good. What about you, Marianne?
Yeah, I have both.
Okay, good. Good. So those are the options for tax-free income. We've discussed the tax-deferred accounts. Tax-deferred accounts is your, IRA, 401k. You'll pay taxes when you get the money out. There's a couple of things that you can do so that you end up not only passing over more money or potentially not paying any taxes on it. Implemented some strategies with some clients that, with your IRA, you can take distributions from your IRA and contribute it to life insurance, because we know that life insurance passes over to your heirs, it passes over to your kids or whoever you name as a beneficiary as tax-free. So there are some ways not only to take traditional IRAs and convert them to Roth IRAs, just pay the taxes on it right away and then never have to pay taxes on it, or there are some ways to take money from a qualified plan, dump it into life insurance, so that your beneficiaries never have to pay taxes on it. Annuities, they basically work just like retirement accounts. You don't pay taxes on the gains as you earn it, but eventually when you take the money, you will have to pay taxes on. The main advantage of life insurance, and I would say the main advantage of life insurance over all the others, is that there's no contribution limits. So, for example, the contributions on IRAs, traditional IRAs, are about $67,000. On Roth IRAs, it's about the same thing. 401ks, it's $19,500 to $26,000. So the reason why there's two numbers is it's the catch of contributions over here. So If you're over the age of 50, you can make some catch-up contributions and contribute larger amounts on a yearly basis. 401ks and 403bs, it's the same thing, about between 19 and 26. There's something called a Simple K. Simple K is just like a 401k, but it's a lot less expensive and a lot less costly to administer. So if you have a small business and you want to start offering something like a 401k, but you don't want to get into, all the, fees and the third-party administrator, all that stuff, a Simple K is a good type of plan. The two types of plans that have no contribution limits are the 412E and, again, life insurance. The most common one is the SEP IRA. SEP IRA, you can save up to $57,000 a year into it. Again, it'll reduce your tax bill. It'll create money for your retirement, planning fund. So it's, Swiss Army knife. It does a good thing. Life insurance and the 412E plan basically have no contribution limit. This is very niche, but some people do implement it. Life insurance, some people haven't implemented. I found throughout the years that maybe it wasn't presented by the right person, or was presented by somebody who was trying to make a sale, or for all sorts of reasons, people bypass that option to create some tax-free income. But you always want to, if you've never done it before, if you don't have it as a part of your plan, you just always want to sit down with somebody that you trust so they can run through the numbers with you and see if it makes sense for you at this particular time. So the last thing that I wanted to share in regards to that before I start taking some questions is the whole idea of using life insurance as a way to create tax-free income. You have to take a look at the cold numbers. Just what's the rate of return on this life insurance policy over the long run? So life insurance policies in the early years is basically barely any returns, but if you let it sit there for a decent amount of time, most policies, I'd say after 10 years, 11 years, you start to see a return on it. In the long run, the internal rate of return on life insurance policy can be about 3%. Most of them that I've seen was around 4%. And if you have something called like an IUL, Index Universal Life, or Variable Universal Life, where you can participate in the stock market and do different things, you can expect a higher return from that. So the importance of this is that nobody gets excited when they see that they're investing in a life insurance policy and they're getting a 5% return on their money. But the power behind it is because you don't have to pay taxes on it, it's much more powerful than a regular account where you would have to pay taxes on it. So for example, getting 3% inside of a life insurance policy is the equivalent of getting 4.62% if you're on a 35% tax bracket. So because there's no taxes on this money over here, you have to be able to calculate the tax equivalent yield and see if it's worth it for you. So the higher the interest rate that you can get on your life insurance policy, or the higher the return, the more advantages and the more smart it is in regards to taxes. So that's the breadth of what I wanted to share. I want to just keep the last 15. I think we have about 10 minutes left. Just answer some questions, and go back on any slide that you guys would like some more details on.
So Andy, I'm gonna apologize because I have to depart in about 3 minutes. I actually physically have to be somewhere for another meeting. So I'm gonna apologize now, but I thought for me, you clarified a lot. You shed some light on a lot of things that I had questions on. So I'm very happy I attended.
Very good, very good. Thanks for joining, Neil.
Yeah, I'll hang out for a few more minutes.
All right, cool. Marianne, is there anything in what I shared today that you'd like to go a little bit deeper in, or if you have some questions?
Yeah, I'm curious about the Section 199.
Yeah, so Section 199, I'm going to share a different part of my screen. And, of course, I know you, but that's the, hold on a second, let me share a different, let me exit this here. Yeah, so in the Excel spreadsheet that I prepared, Marianne, it's pretty much very clear. Let me open up the Excel spreadsheet over here. So you can see these are the different deductions. We'll get to Section 199.
Andy, I don't think we can see the Excel sheet.
Oh, hold on a second
You
here.
might have to share your whole
Yeah,
deck.
share the entire screen, right?
Yes, thank you.
Where is it? Let me see here, this one here. What about now?
Yep.
Yes.
All right, cool. But Marianne, it's as simple as it is. It's just that some people don't take the extra step, but it's right there. So you're entitled to up to 20% of qualified business income. So with your accountant, you'll go through what your business income is, how much of it is actually considered being a qualified business income. But just like I said on the slide, if you are a sole proprietor, and if you are dealing through with a pass-through entity, for example, the LLC or the S corp, you can get up to 20% of that business income as a deduction. It's as simple as it is.
Yeah, that's good to know. I'll look into that.
Yeah, I'm trying to make sure here if there's any.
I definitely agree.
Yeah, it came up. I remember it came up when I was first starting in New York. So it's definitely been there since, I think, since 2016. So if you did not get it in the past, if you haven't heard about it, you did not get it the year prior, check with your accountant to see if you can kind of go back and maybe, amend some of these returns and claim that one, because, outside of just having qualified business account, it's not a mystical thing. You can't get the deduction.
Thanks for everything, Andy. Really
You're welcome.
appreciate your insight and knowledge. Thank you.
You're welcome. Anything else, Marianne?
No, I think you were really clear.
All right, very good. Maxine, Maureen.
Yes, so Maureen had to step out, but I really enjoyed this. I definitely learned a lot. I mean, I'm only 28, so I still have a little time left, but it's good. I was telling Maureen during this is stressing me out. There's a lot more that I should be doing. But we really appreciate it. This was very informative. We will be sending out a follow-up email to who attended and possibly anyone who missed it. This is recorded, so people will be able to watch it back. And then, Andy, if you would want to share that Excel sheet as a link or anything so people have access to it, we can include that as well.
Definitely, I'll do that.
Okay, wonderful. Well, thank
Very
you
good.
so much, everyone. Thank you, Andy. Hopefully we can do this again as well.
Right,
next
absolutely.
year or in the next couple of months. Look forward to more to come.
All right, very good.
Wonderful. Thank you.
You're welcome.
Bye.
Okay, bye.